Welcome to the Economy Magazine. I'm Binyamin Tjong-Alvares with the economics news of the day. Today we focus on Greece, which prepares for a pivotal vote that could be a game changer in Europe. First, a look at the headlines. The International Monetary Fund said Middle East and Central Asian economies would lose $300 billion in lower oil exports. Qatar, Iraq, Libya, and Saudi Arabia, which highly depend on oil exports, will be hit hardest by the more than 50% decline in petroleum prices. The losses are likely to reach 21 percentage points of GDP in the countries of the Gulf Cooperation Council, the IMF said. But the oil price drop will not translate into immediate gains for oil importers in the region that have been hurt by slowing growth of key trading partners. China's economy is not set for a sharp slowdown, Prime Minister Li Keqiang told business and government elites gathered in Davos. Li tried to allay fears of the growth outlook as China posted its weakest growth in a quarter of a century. The governor of the People's Bank of China said the bank would keep money supply stable and not inject too much liquidity in the economy. Beijing has held off broad-based policy easing, but if economic indicators in coming months point to further weakness, it will have to act.
If I could compare China's economy to a running train, this train will not lose speed or momentum, but will be powered by a stronger engine.
President Petro Poroshenko said on Wednesday that Ukraine will be able to completely break its expensive natural gas dependence on Russia by 2017. The pro-Western leader said more than 9,000 Russian soldiers were backing up pro-Moscow fighters in eastern Ukraine. He stressed there was no military solution to the 9-month conflict that has brought Ukraine's economy to its knees. And given the oil dispute with Russia that sparked the crisis, Europe remains its only hope for energy security in the long run. Venezuelan President Nicolas Maduro said he would modify the South American country's complex currency controls. Maduro said he would stick to a 3-tier system, guaranteeing cheap dollars for food and medicine imports at the existing strongest rate of 6.3 bolivars. 2 other rates offering limited amounts of dollars at 12 and 50 bolivars would be merged. Despite an economic decline of 2.8% in 2014 and very high inflation above 64%, Maduro also said the time had come to increase the price of gasoline.
Oil will not return to $100 a barrel. It will not return. So we need to produce, to substitute imports, generate new sources of income for the country.
All eyes at the World Economic Forum in Davos today were on the European Central Bank as it announced its decision regarding the long-awaited quantitative easing. We're joined in the studio by Laurence Schreiber, co-president of Clarity Capital, for an understanding of what that means for the struggling Eurozone and what challenges lie ahead. Mr. Schreiber, thanks for joining us.
Thanks for having me, Binyamin.
So what is the significance of billions of euros in bonds being bought per month and then injected into the trade bloc? What does it mean for the EU?
Absolutely. It's a great question. The European Central Bank has been attempting to stimulate the economy now for several years, but they've had limited tools that they could use. Central banks generally can only focus on the very, very short end of the interest rate curve by increasing or decreasing the short-term rate. The U.S. started several years ago the first program of quantitative easing in a large scale. What that essentially means is they are authorized to buy their own government bonds, which allows them to essentially influence the long-term interest rates.
Right.
And by buying bonds and artificially pushing down long-term interest rates, they're able to provide an additional level of stimulus.
So how long will it take to have an impact?
It's a great question, and I don't think any of us really know the answer. It'll be very interesting in the days and weeks ahead to see how the market responds. They're actually just announcing today that the scope of the program will be approximately 50 billion euros a month through the end of 2016. That's slightly above what I think most market participants had expected. So we are getting some slight positive, impact, but it remains to be seen how this will play out over the next few weeks.
Of course. And what role does the appreciation of the Swiss franc play in all of this?
Well, that was a huge shock last week, the Swiss central bank, clearly now we see in preparation for what was going to happen this week in Europe, announced a real surprise, which was for 3 years they had pegged the Swiss franc to the euro, not allowing it to strengthen. And they shocked the markets last Thursday when they removed that peg. The Swiss franc appreciated 43% immediately during the course of the day and settled about 20% stronger. The ripple that had through markets ended up shutting down a number of hedge funds. Major banks took big losses. Clearly, markets were not prepared for that. On the other hand, the announcement by the European Central Bank seems to have been much more expected. And clearly, we're seeing that the markets are ready for this to happen. It would be a shock if they had not made these big moves.
Now, would you say, I mean, these are obviously two big key subjects at Davos. Where do you see it going in terms of the quantitative easing in Europe?
Well, so I think that this is an absolutely necessary step. I think if the ECB had not stepped in, there is starting to be despair about what could be done for Europe to restart the engine. The problems in Russia, the problems with oil prices decreasing, which is hurting many of the oil exporting countries, that's just another step down for the economy. So they needed to take action. I think what we'll see now is there'll be a pause.
Right.
We'll let the stimulus take effect, and hopefully that will start to restart the engine. In terms of Davos, I think the most immediate impact for participants there is their hotel bills just got 20 or 30% more expensive when they check out in Swiss francs, based on what happened last week.
Will we actually see the money trickle down?
So that's a great question. When the United States did its quantitative easing, it was relatively simple because you had one central bank and one country. Mm-hmm. In Europe, you have one central bank, but 19 different countries, each with their own sovereign treasuries. So now the ECB has to decide which countries' bonds will they buy and in what amounts. And those are the announcements that are just coming out today. And as they continue to pursue this program, there will be a lot of questions about which countries will be stimulated and in what order. And there's going to be a real challenge for the ECB to manage that without seeming to be partial to individual nations.
Okay, now one of the main challenges for the European zone has been, of course, that you have Germany on the one hand, very strong economy, you have the pigs, so to speak, the southern European economies. On the other hand, big differences in terms of whether they are fighting, deflation versus inflation. I mean, how does the quantitative easing, how could it affect Germany versus, the pigs?
Correct. Great question again. We've already seen in the very short term, since the announcement, interest rates in Germany started to rise, despite the fact that they've announced they're going to be buying bonds,
right,
while interest rates in the peripheral countries have actually declined. So the market is expecting the bulk of the stimulus to be happening in these peripheral countries, which really need the support, and probably at the expense of Germany. So once again, if this continues to play out as expected, Germany will be the driver, will be the engine supporting the rest of the countries. And it will become a big political risk as well. How long will Germans be willing to say, we will support our less well-off neighbors?
And where does this leave Europe's second economy, France?
So France is actually in a stronger economic situation than many of the other peripheral countries, but they don't like taking a second seat to Germany. Mm-hmm. They want to be more involved and active in decision-making, and I think they will continue to make their voices heard.
Okay. Well, Laurence Schreiber, co-president of Clarity Capital, thanks for joining us.
My pleasure, Binyamin.
Thank you. We move on to Greece, where anti-austerity party Syriza is leading in opinion polls, days ahead of a general election on Sunday. But given the country's massive 317 billion euros in debt, Sunday's vote could be a game changer, both in Greece as well as in the EU at large.
Though just weeks ago, Greece seemed set to pull out of a 6-year recession with a growth forecast of just under 3%, a snap election was called to take place on the 25th of January. Despite good news on the growth front, unemployment is still over 25% and nearly 60% among youth. Political uncertainty, it seems, is part and parcel of job uncertainty. And Prime Minister Antonis Samaras' Conservative Party may not hold up against the anti-austerity Syriza party.
Before 2010, no one could ever imagine that a small radical party in Greece would be in position in 2015 of being, as it seems, the next government. Syriza reached this point because it's a product of a real necessity.
Syriza, a party with Marxist roots, has toned down its rhetoric in anticipation of picking up more votes and putting foreign investors at ease, according to AFP. Still, they are clear in their aims to renegotiate Greece's bailout package of $284 billion from the IMF and EU, which has forced major austerity measures, including layoffs, wage cuts, and tax hikes on Greeks.
In the last year, Greece was chosen to be the guinea pig of austerity in order to exit the crisis. This was proven to be a failure and catastrophic. Europe is not a homeowner that is renting its house to pariah countries. Europe is our common home, and no one can be kicked out of our common home.
There is worry that Greece's creditors will refuse to renegotiate, and Greece will default on its debts. Syriza, though, is banking on recent acquiescence that austerity policies have largely failed, which they hope will spur negotiations. Meanwhile, some suggest that Greece's recovery has been propped up by tourism, which has picked up as it's been less expensive for visitors. If that is the case, the Greek economy would need a wider platform for recovery.
Greece is a country which needs foreign direct investment. It needs to improve its export capacity. Right now, these are two key drivers of a recovery. If that recovery stalls, if that recovery stagnates, this is also bad news for the social cohesion of this country.
The IMF has suspended payments until the new government is formed. Syriza, meanwhile, aims to restructure the country's debt so it can be paid back in what party leader Alexis Tsipras calls a socially viable way.
Global warming has been the buzzword for quite some time now. Recent reports show that 2014 was the hottest year on record. In today's Green Corner, reporter Batya Sushirabi joins us to discuss the economic impact of global warming. Batya, thanks for joining us.
Thank you.
So, what is going on here? 2014 was the hottest year?
Yeah, the year 2014 was the hottest year on record for the planet. In 135 years of record keeping, 2014 ranked the hottest. Global temperatures were 1.24 degrees Fahrenheit above the 20th century average. Now, this is evidence of an ominous warming trend for the globe.
The question is now, why does it matter? I mean, we've been hearing about global warming for the longest time now. I mean, what is the economic impact of all of this?
Economic impact is huge. Economically, the overall climate change is costing the world more than $1.2 trillion, costing 1.6% annually from the global GDP. Let's take Hurricane Sandy, for example, which cost an estimated $1.8 million in structure and home damages. Hurricane Katrina caused $40 billion in claim. I mean, these are just some examples.
And, I mean, are all countries equally to blame in this situation?
Are all countries? No, I would say more the developed countries, the wealthier countries, which are emitting a lot of carbon dioxide. China and U.S. are the two top emitters. Mm-hmm. This is actually part of the grappling that was going on during the UN climate action call for change debate plan. There was a lot of grappling. They weren't sure it could be hammered out because the developing countries were saying the wealthy countries were to blame. Mm-hmm. In the end, it was decided that all countries were going to, for the first time, step up.
Right. Based on this, the 331-page study entitled "The Climate Vulnerability Monitor" by the Dara Group, they basically said that the cost of climate change and air pollution, I mean, the majority of this is going to be carried by the developed world. I mean, it's unbelievable, really. Ultimately, of course, you know, the developed countries tend to have all the tools that they need in order to absorb, so to speak, the shocks. I mean, Katrina was horrible, Sandy was terrible, but at the end of the day, the U.S. government has the means to deal with it. If you look at the developed world, it's a completely different story, right?
Well, it's not just the U.S. European Union nations are also being asked to all step up and cut down emissions by 40% by the year 2030. Mm-hmm. As far as being fair, let's say, the developed countries, that's their claim, is that they are the victims of this climate change. They want the developed countries to help pay for a lot of the damages.
Well, I think it's a fair charge, really, from their point of view, because when it comes to the developing countries, rather, I mean, we see that if the agricultural sector is affected by global warming, I mean, we're talking, specifically malnutrition, lack of agricultural produce. It has a direct effect on the people that live there.
Well, yeah, and also globally, it's costing 1.6% annually. Was that your question?
Yeah, I mean, that's basically what it comes down to. So where do you see this going from here? Do you imagine that there's going to be more of an input and investment in this issue? Well,
that's what the UN summit was in Lima, Peru. So for the first time, 190 delegates from 190 countries were present, and they drafted a 5-page plan called the Lima Call for Climate Action. The broad outlines of the plan are that all countries for the first time step up to cut greenhouse emissions. Okay. China and the U.S. are going to work for a UN Accord.
Okay, well, Batya Sushorabi, thanks so much for joining us for the Economy Magazine. That is the Economy Magazine for today. Thanks for watching. I'm Binyamin Tjong-Alvares. Join us again tomorrow.